Alrighty, folks, it is pretty clear that the job market is deteriorating. We got a JOLTS report that was super ugly, an ADP report that was even uglier. And of course, we're on the cusp of non-farm payroll tomorrow. I believe the market is already starting to price in not a 25 basis point cut, but it looks like we might go supersized and 50. I do not agree with it. I do not think it's a good idea, but when I think does not matter. What I want to talk about is the market pricing in a larger rate cut. What is it doing the mortgage rates? What is it doing conventional DSCR? We're going to talk to our boys from Convoy Home Loans, Dustin and Jonathan. It's wild out there, guys. What's going on?
Yeah, it is wild. I know we were speaking just right before this, but with the job market clearly deteriorating, there's going to be a lot of the market that is expecting now for a 50 basis point cut in September. I know it's been 25 riding for the last 2 months, month and a half. But a lot are calling for a 100 basis point cut, by the end of the year in November and December. And that's, of course, going to help mortgage rates be lower, right? And
Yeah.
the biggest thing, and everybody knows, I think, from watching us enough on this channel, is that we do operate mainly in the non-QM space. And what we've seen recently is the 5-year right now, I think, is at 3.52 or something, and the 10 years at 3.7 whatever 5. Okay. And for the last, basically all of 2024, they've been identical, the 5-year and the 10-year. That 20 basis point spread right now is causing non-QM DSCR rates, bank statement rates, in a lot of cases to be lower than conventional rate. Like right now in terms of rates, which is, we always talk about it. Sometimes non-QM's lower, sometimes it's higher, sometimes it's identical. But as of today, Thursday, September 5th, non-QM's trading lower, and that's because the 5-year's lower. So
this is wild to me. Let's try to put some numbers on this, because again, I Lance Lambert, somebody I respect and have on the channel every week, he puts out a tweet every business day talking about where the mortgage rates ended, quoted from Mortgage Business Daily, I think. And yesterday, I want to say the quote was 6.37. Now that's conventional, that's owner occ, all the normal caveats. Are we talking DSCR sub 6? I mean, is that even possible today?
Yeah, absolutely. And depending on the LTV, honestly, like if you're at like 60% LTV on a purchase or refinance without pulling any cash, you're going to be at 6% without buying anything down, 30-year fixed.
Car is 6?
Depending on where the market is, it might even be like 5, 9, 8 on a good day, So wow. It's there. And obviously you got a few messages from people that close with us, and we are actively closing like deals, and the savvy investor is not asking like, hey, where can I, like, how far, where's the rate right now in terms of par? They're asking, how far can I get it down to not have to worry about the market and just keep moving on?
Yeah, this is wild, because it's one thing that we got right. I called for a refi boom about 8 weeks ago and nailed it, right? Refis were up 94% on, we reported that yesterday. And I think Dustin and I had this conversation right before I left. I think I was nervous that rates would be on a rapid trajectory to sub 6, something with a 5 on it, as an average. I suspect if we get there, we can not only see purchases go up, but we might see a serious doubling of investors doing cash out refis, and not only rate and term, but we may have a lot of investors just take cash out to redeploy in this next part of the cycle. I don't know.
Yeah, and I mean, I saw your video, actually. It was interesting. We were talking about Dustin this morning. It's like you were calling, like, I think it was like last week or something. You were on a boat and you were like, I want the feds to wake up and look at the actual thing and just kind of keep everything lower or higher for a little longer, right? Stable. Yes. And we're not even talking about increasing the rates. We're talking about just keeping it where it's at, right? Like even where it is right now. And Dustin and I mean, obviously we come on the channel and talk about this all the time. We couldn't agree more all the time, right? Because it's not good for the market to have these fluctuations in rate. It doesn't do anything good for anybody, right? So I think that's the main thing that we want to get across to clients too. It's like, hey, this looks good, right? And it feels like an opportunity, but it actually doesn't mean that it's good for us, because what'll happen afterwards is if inflation goes back up again, rates are going up again, and then we're gonna repeat this cycle again, and that's gonna
Yeah.
be, a doom cycle essentially.
Yeah, I mean, if people want to go back and look at the early 80s, they need to do that, right? The early 80s, the Fed was on a rate hiking cycle. They thought they licked inflation. Arthur Burns cut rates, and the second bout of inflation was much worse. Actually led to the worst recession before the Great Recession. It was nasty 81, and it took Volcker, taking rates to an unheard of level to finally break it. But that was 18, 24 months of just pain. The second one is worse. And that's my fear. That's my fear. We get rates so low, we just do it again. It's frightening to think about.
Yeah, I mean, we keep saying it, you guys both just said it, but we need a gradual simmering of the market to keep home affordability, intact. And that's part of the Fed's goals, right? And we can't have a significant continuous rate drop, because all that's going to do is put us back to where we were. And we're trying to, knock down the walls of making home affordability, actual, possibly for the middle class. And I saw it was interesting. I think I read something yesterday, but in August, even with all the rate drops, right? Like the August purchase demand, we had a little blip, little increase, right? Sure, refis were up, but comparative to when at the beginning of the year and last year, rates were in the same position, we're not even close, right? And that's still because the average consumer has now ridden this path for the last year, and they see the affordability, not just for homes, but the way of living, so that 6.3 or 6.4 that looked way more attractive a year ago than it is today, even though they're identical, is because now the consumer is actually able to bake in the rest of their expenditures.
Yeah, it's wild out there. One of the things I was thinking about is, as an investor, when would I go back and extract equity from a property, right? There's we'll just make up, I own a fourplex. Let's just say, for, shits and giggles, it's worth 800 grand and I owe 400 grand. Make the math really easy. And let's say today's rate on that building is, I don't know, let's call it 4.5, right? 30-year fixed, 4.5, 50% LTV, cash flows just fine. When would I go back and extract equity? Because at some point, at some rate, there's at least $200,000 of equity, dead equity in that building, right? I could get it to 75 pretty easily, if not 75, maybe 70. But there's hundreds of thousands of dollars there. And I can tell you this, I'm not going to go get that 100 grand at 8%, right? Because that would make it an alligator in most cases. But there's a number, and it's probably not that far away, right? If I could get, 30-year money at 5.5, so my rate goes up a point, I bet you it still cash flows. And I haven't done the math, but I'm just thinking here as an investor, if rates keep on a rapid trajectory lower, what moment is that great unlock? Because there's lots of investors and homeowners who have hundreds of thousands. There's trillions of dollars in equity, untapped equity. What do you guys think?
I mean, we talked about this before with the second home loans and such, right? And I think where it really makes sense is when you're doing a blended rate, right? And the blended rate is actually higher on a first plus a second, instead of being, a total cash out refinance. Where's that rate, right?
Right.
So, in a case where it's like, maybe you're in that example, maybe you're in a $400,000 first, but that's at like a 4%, and you take out a second loan and it's like 8, 9, 10, 11, 12, 13%, then it might be a position where if you blend them together, it might actually be better to just refi something at 5.5, right? Depending on where the second is. So
yeah,
I think
it is a math. This is why I love working with you guys. You're willing to educate people. You're willing to do the math with them. And that is exactly the right answer, right? If you're going to, and it's not going to make sense to pull out 20 grand, because that you'll just do a second. But if I'm going to pull out hundreds of thousands of dollars, that probably pushes the blended rate above a new first.
Yeah. And that is obviously when, and we're actually seeing a lot of people do that right now. And the savvy investors that are like, that are not emotionally attached to the rate. And this is what I think the key is for a lot of investors that are newer investors. They are so emotionally attached to the rate that they are like, I will live and die by this 4.5% that I have on this thing because I know I can't get it back. And I'm like, but the math doesn't work in that sense. But they'll take a worse loan on a second or whatever because they don't want to get let go of that first rate, you know. And I think a lot of investors, if you want to be an investor, you can't be married and like you can't be emotionally attached to the actual rate because at the end of the day, you have to look at the cash flow you're getting on the property, right? So
Now, yeah, I agree with all that, but let me just speak to the homeowners for a minute. If you're a homeowner and you have a 2 handle, which is below the rate of inflation, don't touch it. Don't you dare touch it. Let's just get that off the table right now.
Yeah.
Exactly. But I mean, Mike, speaking of all this, I mean, in what world, because obviously we talked about clients, and again, clients have reached out to you for rates in the 5.5 that they're closing with us, right? Buying down points or whatever. When would you, right, actually buy down the rate to a 5.5? Like if you would, or would you at all?
Oh, I absolutely would. I mean, I think there's a couple of things, and I'll answer it both ways because I think the audience needs both. If I was in growth mode, versus if I was in just, kind of steady state mode. I want to give both answers. If I was in growth mode, which again, I was in growth mode for 15 years, most people are in growth mode for at least a decade, you're actively thinking about leveraging equity. And I just want to make sure I get this right. During growth mode, I only ever did a single cash out refi of any asset. No asset I owned ever did that twice. So knowing that, I would buy down the rates. Most important to me is 30-year fixed, always 30-year fixed, but I would definitely buy down the rate. And for me, what I would be looking for is I'm trying to hold this forever, right? That is my time frame, is I'm always trying to hold the asset forever. I'm going to assume all loans will be termed out after the cash out refi. So yeah, I would usually buy points. I can think of most of the loans I did pay at least 1 point because it just made sense for me. I wasn't looking to do, multiple cash out refis every 2 years or something. So I would definitely look at it. I'd like to get my payback period something less than 2 years, 18 months being a great place. But again, I'm going to hold it for 30 years. So,
Yeah, and
that's
the
what I'm
payback.
thinking.
That's the main thing, though.
Yeah.
Like you gotta when you're doing this, and I tell this every time that I'm going over this situation with clients, it is still a gamble. Now, 3-4 years ago, 8 years ago, when we were in the industry, and we thought we were at the bottom, you wanted to get the rock bottom.
Oh, of
right?
course.
And you didn't care what the points being paid for, to get there was. And I'm supposed to be on Do Not Disturb. I don't know if you guys can still hear me.
No, yeah, we're good. We're good.
But essentially, in this market right now, and I may be different than John in the way that I will review these items with clients, and it depends on the investor, of course, as well. But I know we both speak about this. It's you run the numbers in terms of what's the payback period. And then that gamble is in this type of market, in a market where we know in the next 2, 3, 5 years, the chances of rates being lower than they are today are higher, right? The chances of rates being lower 3 years from now are higher than they are with rates being higher. That makes sense. It's like not saying higher and lower too much. So with me, I've been telling a lot of clients, look, I want to put you in for example, a DSCR loan that's maybe a 1 or 2 year prepay with no points. Okay, you'll take a little bit higher rate, but the ability to refi and not be like, oh shoot, I did a buy down for 3 points and it's going to take me 4 years to recover. If I refi over the next 4 years, I lost money on that decision, right? That's what it all comes down to. And it's a little bit harder, I think, for an investor to make that decision in today's market because the market is supposed to get lower rate wise. Whereas 4 or 5 years ago, you knew that at 2.25, I ain't getting ever lower than 2.25. So I'll pay it down to 2.25 and call it a day. I think that's a conversation I'm having a lot.
Yeah, and let's answer the second branch of that. So that was when I was in growth mode, but let's talk about it today. There's a lot of investors, myself included. I'm here today. That fourplex example we talked about is pretty much close to the exact numbers of an asset I own. And yeah, there's a good chance that I might do a cash out refi to, because there's so much equity growth. I don't like to leave the equity there, that much equity there. And there's again a very good chance that I would buy down because my hold period is forever. I'm not playing the 3, 4, 5 year game. I'm not the guy that's gonna refi every 5 years. I'm the boring, lazy, set it and forget it guy. And let's talk about expectations, because I do think a lot of investors have a recency bias, and they have a recency bias that says a 2% mortgage is possible. When I was in growth mode, 5 was like unheard of. Like a 4 handle was unheard of for an investor. So yeah, when we were doing these decisions at that time around, we were like, we're close to the bottom, right? We're a quarter or a half from the rock bottom. So it was okay. I think a lot of people are going to have distorted views about what's possible for mortgage rates. What do you think?
Yeah,
It's John.
we really don't obviously what the last 3 years have taught us is we can guess, but we'll never know, right? The market is kind of always in this is what we always try to remind people of. The mortgage rate market entirely is forward looking, right? So I think at the end of the day, Wall Street and the market that Wall Street sets is smarter than the average person, right? So it's going to be very hard to guess what the market's actually going to do. But looking forward, and again, that math that Dustin did in terms of the payback period and what you're looking at, like that's the most crucial part of whether you buy it down or not, right? But same thing with the blended rate average. But if you have kind of a view where your loan amount's kind of a certain size and your dollar amount like is incrementally less savings that going down in rate, right? Because if you're going from let's say you lock in at a 5.5 on a 30-year fix, and this is the other math that I do for them, 5.5, and then let's say it goes to 4.5, what's the payment difference there? Is it going to be worth refinancing at that point?
Yeah.
Right. So running through that is also important. So I think if your outlook on rates is kind of like you want to set it and forget it, like you said, right? Then and your horizon is longer, then just buy it down as low as possible and just keep it there.
Yeah. No, I love it. And again, this is why I love Convoy Home Loans coming back each week. I appreciate you guys being here. How do people get a hold of you and run through scenarios?
Go to convoyhomeloans.com and please let us know you came from ORAT.
Folks, you got to tell me you came from ORAT. Otherwise, you end in the queue. If you tell me you came from ORAT, you get one of these two guys. Thank you very much.
Thank you.